Hello, everyone. I'm Debbie with TSIB. Welcome to TSIB's Construction Risk Management Seminar, Day 2. We are so excited to be here with you. I'm going to introduce our speaker in a moment, but first a couple of housekeeping notes. This session is pre-recorded, but we will have a live Q&A at the end. We ask that you stay on mute and off camera during the session. Mike Dugan is here with us today. So if you have any questions, we ask that you post them in the chat feature located at the top right of your screen. Mike will also be chatting with us during the entire presentation. So as you're watching the video, you can post anything in the chat. But again, we will have plenty of time at the end for any questions. The entire session, including the Q&A, will be available on demand on TSIB's YouTube channel. Lastly, the material covered during the session presentations are for informational purposes only. It should not be construed as legal advice. It is highly recommended you contact your attorney for legal advice. So without any further ado, I'm going to introduce our speaker. This is Mike Dugan, a surety specialist at TSIB, and he is presenting Should You Bond Back Your Subs? We are so excited to have you here with us, Mike. Why don't you say a quick hello to everyone, and then we will get started.
Thanks, Debbie. Hi, everyone. Thanks for joining us today, and I look forward to answering all your questions.
Great. All right, I'm going to press play.
Hello, everyone. My name is Mike Dugan from TSIB. In this presentation, I'm going to be talking about bonding back for contractors and why we think that's a good idea in general. So savvy owners know that requiring performance and payment bonds on a construction project can provide significant protection against the downside risk of a general contractor's failure to perform the work or pay its subs and suppliers. Performance bonds ensure the contractor's performance of its contract with the owner, and payment bonds help to ensure the contractor's payment to third parties who furnish labor, material, or equipment on a project. Likewise, smart contractors should also consider requiring performance and payment bonds from their first tier subs to manage the risk in any construction project and to protect against claims from subs and suppliers further downstream. Establishing and following a rigorous subtrade pre-qualification practice is a key part of risk management for all contractors. However, carrying out such a practice can be challenging. The justification of "we've known that sub for years" is a common pitfall when looking at subcontractor risk management. While most contractors likely know the history and performance capability of many of their subs, they're likely not in the loop on any financial challenges they're facing. With pressures mounting from backlog and labor shortages, COVID-19 project and material delays, maintaining healthy margins can be a challenge for any trade. To manage these concerns and avoid defaults, it makes good business sense for contractors to give themselves as much protection from performance or default issues as possible. One of the more comprehensive risk management tools for general contractors to consider is to mandate surety bonds from key trades on larger projects. So what is a subcontractor bond? A subcontractor performance bond is a project-specific agreement between the GC, the subcontractor, and the subcontractor surety company. The performance bond ensures the sub's work will be completed on the project, consistent with the terms of the contract. If a subcontractor finds that it cannot complete a project, the surety company can then step in and either help the sub complete the project or find another company to complete the work for them, among other remedies. In general, a subcontractor performance bond protects the GC from the risk of default on the work. Note that the performance bonds do not protect a sub's lower tier subs or suppliers. The payment bond, also a three-party contract, ensures that the subs and vendors are paid. Performance and payment bonds are often required together on projects, and it's common to have both issued simultaneously. You may also be familiar with bid bonds. GCs have historically not asked for bid bonds. Instead, the general contractor may require a surety letter, also known as a good guy letter, from the sub that states the subcontractor's bonding capacity. However, there is a growing trend in the industry for large general contractors to require actual bid bonds. A bid bond gives the GC a higher level of assurance that a subcontractor qualifies for a particular job, while good guy letters are really just an indication of bondability. In practice, bonding limits on these letters are often inflated, and the surety generally assumes no liability if it does not actually approve bonds for a given project. Bid bonds, on the other hand, have real-world consequences if the subcontractor chooses not to enter into a contract with the GC. So why are subcontractor bonds required? Unlike prime contracts, bonds typically are not mandated for subs by law on public works jobs. Instead, the GC decides whether to require their subcontractors to provide a bond back. Smart general contractors understand the importance of transferring the risk of a subcontractor failure by creating and sticking to a subcontractor bond policy. The general contractor should establish rules for requiring subcontractor bonds depending on things like the scope of the subcontractor's work and the type of project. So when then should you request bonds from subtrades? On federal jobs, projects of $150,000 or greater must be bonded. States have separate laws and project size thresholds for bonding, though most are in the $100,000 range. There is no mandate, however, for the bonding of subs on public or private jobs, so the decision falls on the general contractor. The general rule of thumb in the surety business is that bonds should be considered for all major trades that represent a large percentage of the total job, or from trades that are completing a critical path scope of work on the project, or from unfamiliar subs tasked with a substantial portion of a job. While there is a cost associated with this, usually between 1% and 3% of the subcontract value, it's not a high cost when considering the protection and peace of mind that bonding provides. The following are a few of the factors in considering the bonding of a subtrade: the contractor's familiarity and past experience with the scope of work, size of the sub's contract value in relation to the overall project and the potential impact on the project's critical path, size of the sub's contract versus the size of previously completed contracts of similar scope, the subtrade's prior experience with the location and owner of the project, specialized nature of the work performed by the subtrade. It's important to consider the availability of replacement contractors and/or suppliers in the event of a default. Projects with an aggressive timetable for completion, particularly when significant liquidated damages are involved. How much of the work will the sub self-perform, and what subs will they need to hire? And lastly, the GC's in-house requirements. For example, a GC may have a rule that subcontracts over a certain amount, say $100,000, must be bonded back. So how can bonding help with the subcontractor selection process? As most contractors are aware, in order to qualify for bonding, companies go through a rigorous underwriting review initially, and then annually, semi-annually, or more frequently thereafter. These reviews include a careful look at the company's backlog to see how profitable their work is, a review of any receivables issues that could hinder future performance, and a careful evaluation of their ongoing financial results. While subcontracts contain unique risks, the surety looks for the same basic qualities in a subcontractor as they do in a prime contractor: capacity, capital, and character. It's helpful if the subcontractor has experience working for the general contractor and has established a good relationship. The surety company should be seen as an important part of the pre-qual process by giving an owner or contractor peace of mind that the subcontractor has been vetted by a qualified third party, one with skin in the game if a sub defaults. This helps owners and contractors narrow in on subcontractors that are qualified financially and technically to complete the scope of work. And just as importantly, subs that aren't qualified can be weeded out based on their ability to get a bond. But what happens when a default occurs? Although subtrade defaults don't happen frequently, they do happen, or when they do happen, they can be devastating to a project construction schedule and also cause significant financial pressure on the prime contractor. When there is a default, the assistance provided by the surety can come in several ways. First, if the sub is bonded, a surety should have already completed a thorough pre-qualification. A GC would have a better chance of dealing with a subcontractor that has some financial standing which could help mitigate the default. Second, the surety can help facilitate discussion between the sub and the general contractor to keep the project moving. And third, by way of the indemnity agreement between the surety and sub, the surety may have an obligation to, in a worst case scenario, step into the shoes of the defaulting sub to keep the job moving forward and complete the contract. This, after all, is ultimately the reason for contract bonds in the first place. Now, the surety has several options it can exercise after it determines that its contractor is in default. They can tender a replacement contractor to the owner, help the sub complete the work by financing or propping up the defaulting contractor, assume takeover responsibility for the contract. The surety then hires a completion contractor to see the project through to completion. The surety can deny the claim entirely, or some combination of remedies, including cash settlement to the owner. It's important to note here that, unlike with insurance, the sub will be required to pay back the surety company for any expenses paid out on the sub's behalf when dealing with the default. Are there any disadvantages to sub-bonding? So it's true that a subcontractor bonding requirement may limit the available pool of subs who are qualified to submit competitive bids. Another obvious disadvantage, and the one contractors most often cite, is the additional cost of getting bonds from subs. While it's common to hear "I won't be competitive" or something similar, smart contractors give this serious consideration, especially since a single rogue sub can potentially derail an otherwise profitable job. Requiring subcontractor bonds will, of course, add an additional expense to the sub's project costs, which will then be passed along to the GC. The rates for subcontractor performance and payment bonds typically range from 1% to 3% of the subcontract amount, as previously noted. Note that in many cases, the GC's own surety may require it to bond its larger subcontractors, especially for larger stretch jobs or jobs involving specialized work scopes, as a condition for approving a bid. Next, pre-qualifying the PreQualifier. So just as the surety company pre-qualifies subcontractors before bonding them, as a GC, you'll want to make sure the bonding company your sub uses is itself qualified. The financial strength of insurance companies, to include sureties, can be found at AM Best Company. AM Best issues a letter grade on a scale from A++ to D to signify the relative strength of bonding companies, along with the corresponding financial size category based on a company's available policyholder surplus. Many public owners will limit acceptable surety companies to a letter grade of A or better. And in practice, whether you're a GC or a sub, you'll only want to deal with companies rated A or better. In addition to AM Best, you might want to take a look at the U.S. Department of the Treasury Circular 570, which is a list updated every July 1st with the names of corporate sureties qualified to write bonds on federal projects, along with a corresponding dollar limitation. Frequently referred to as the T-list, the companies found in this list have been vetted by the U.S. Treasury Department. Used in conjunction with AM Best, this information can give a good sense of the financial strength and size of a surety company. Onerous subcontract clauses to be aware of. Whether you're hiring a GC or a subcontractor entering into contracts with a GC, it's a good idea to get a sense for how surety companies view contract clauses and which to watch out for. It's no secret that general contractors try and shift as much project risk to their subs as possible. Many general contractors use their own customized subcontracts and bond forms. The subcontractor's surety will require a copy of the subcontract and bond forms for review prior to approving the bond. The surety wants to make sure there are no particularly onerous terms and conditions for the subcontractor and, by extension, for the surety company. So, with that said, here are a few examples of common subcontract clauses that sureties consider onerous. Consequential damages. This is a big one for sureties. Underwriters want to avoid bond forms that allow for essentially unlimited consequential damages and limit this, either contractually or via bond writer, to some percentage of the sub's contract if it can't be waived entirely. Clauses that are too onerous will in most cases prevent a sub from getting approved for a bond. Liquidated damages. Owners and contractors frequently treat liquidated damages as an afterthought. If a contractor breaches a contract by failing to complete the work in a timely manner, the remedy is typically an agreed upon amount as liquidated damages. Underwriters pay close attention to these clauses as well. Damage amounts that are excessive in conjunction with aggressive project schedules can be cause for alarm for most surety companies. Next is pass-through liquidated damages. On large projects, the liquidated damages assessed by the project owner in the event of a delay can be significant. As an example, the liquidated damages on, say, a $150 million project might be tens of thousands of dollars per day. Many contracts simply attempt to pass down the liquidated damages from the prime contract to the subcontractor. The surety will want to know the specific amount of liquidated damages and how much time the sub has to complete the work. Sureties will object to contract wording that allows the subcontractor to be charged with all liquidated damages, regardless of who is responsible for the delay. Liquidated damages should ideally be allocated proportionately to the amount of fault the subcontractor bears. No notice required. The surety may object to a subcontract that does not require the GC to notify the surety of contract changes that can increase their liability. There have been situations where the subcontract language even allows the general contractor to default the subcontractor without notice. This can, of course, leave the door wide open for a general contractor to default and replace the sub without giving the subcontractor and its surety the opportunity to cure the problem. Likewise, it's important for the GC to adhere to the notice provisions in the subcontract. If the general contractor fails to follow the requirements of the subcontract, it may not trigger the surety's obligation under the bond. So before acting too quickly, make sure you have complied with all the notices and termination requirements in the bond and any incorporated contracts and subcontracts. Subcontractors often make the mistake of signing contracts without fully understanding the consequences of terms and conditions. Smaller subs often view seeking legal advice as too costly, but it's far less expensive to have an attorney review and negotiate a sub's wording than it is to hire that same attorney after construction starts and a dispute erupts into an expensive legal fight. It's important to note that many general contractors are willing to modify conditions that are objectionable. And next, force majeure clauses in COVID. While this isn't necessarily a subcontract clause per se, this is something that sureties are beginning to test the waters on. Whether a pandemic such as COVID-19 is a true force majeure event, significant enough to completely absolve the surety of its obligations under the performance bond, remains to be seen. Ultimately, this will continue to be tested by courts, but we've already seen at least one case where a subcontractor surety insisted on attaching a force majeure rider to a bond, absolving it of liability in the case of a pandemic, among other things. The GC refused to accept the rider, noting that if the general contract does not allow for force majeure, then the GC and its subs are not entitled to claim it. Bonds before starting work. Sometimes the general contractor allows the subcontractor to begin work without the bond in place. While it may be tempting to have the sub start the job and worry about the bond later, it's never a good idea. If the bond is a requirement of the subcontract, it will be enforced eventually. Once the work starts, the sub surety will demand written confirmation from the general contractor that there are no performance or payment issues on the job before approving issuance of the bond. Or it's possible the surety may decide not to approve a bond on work that has already begun, just as a matter of company policy. Meanwhile, the bond approval is kept in limbo, with the general contractor and surety locked in a stalemate. The general contractor may lose patience and refuse to pay the subcontractor. Far better to make it a set-in-stone condition to get the bonds before allowing a subcontractor to begin work. Next, a word on SDI versus sub-bonds. You may already be familiar with subcontractor default insurance, also known as SDI. Introduced in 1996 under the brand name SubGuard by the insurance company Zurich, subcontractor default insurance was marketed to large general contractors as a surety bonding alternative. It was designed for general contractors willing to take on more of the default risk of its subs in exchange for a reduced cost product. SDI, when properly managed, can streamline the default and remedy process and keep a project on schedule. However, one of the biggest missing pieces for SDI is the robust pre-qualification process that sureties take on prior to approving bonds. Without this, GCs can take on substantial risk of using unqualified subs. Because of this, SDI should really only be considered by GCs with sophisticated risk management practices and serious sub pre-qual programs. because the claim deductibles can run into the hundreds of thousands of dollars with SDI, it's designed for very large construction projects in excess of $100 million. And in conclusion, subcontractor performance bonds are a way for a GC to ensure that their sub's work will be completed. The bonds protect the GC if the sub defaults on the project. If there is an issue with a sub's performance, the surety company will step in. For subs with a growing number of general contractors requiring subcontractor bonds, it's important for these subtrades to be prepared by managing their finances to bolster the strength of the company and becoming more quote-unquote bondable. And for general contractors, it's wise to begin more prudent practices of risk management, particularly now during this period of uncertainty. Surety bonding for subtrades is just one aspect of a strong risk management toolbox that should be considered, especially for larger critical path trades. After all, the stakes are too high. Thank you very much. If you have any further questions, here is my contact information.
Great. Thank you so much, Mike, for that wonderful presentation. Now, let's open up our Q&A portion of the event. As a reminder to the audience, you can post your questions in the chat feature located on the top right of your screen. So let me look here. Okay, Mike, first question's up. The sub I want to use hasn't been bonded before, but I'd still like to use him. Besides bondability, what else should I look for when pre-qualifying a sub?
Thanks for the question, Deb. Good question. I would say whether the sub is bondable or not, you definitely want to look at experience, safety-related information for that sub, and probably financial information if that's something you can get. A good starting spot might be a questionnaire completed by the sub that includes information on, say, the owner's performance history, their licensing information, and definitely safety history. The financial statements from the past 2 fiscal years might also be a good idea, and ideally these should be either reviewed or audited by a reputable CPA. Insurance certificates, of course, confirmation from labor unions that the sub is in good standing there, perhaps a safety manual, and definitely references. And it's also probably a good idea to consider doing an annual review for updates from all pre-qualified subs, just to make sure that there hasn't been any changes in the company's financial position. But thank you for the question.
Great. Let's see. We got another one here. Yes, coming in now. My surety required a trade sub to bond back his subcontractor on a recent bid. Now that the job has been awarded, he claims he can't get a bond. What should I do?
Very good question, and probably happens more than most GCs would like. So you have a few choices here as the GC. Obviously, you can try to get another qualified sub that can provide a bond, and this probably would likely be the surety's preference as well. If that's not possible, you may also want to negotiate with the surety to have that requirement waived. Not always possible, but the surety, if they do agree to that, they may want to underwrite that sub further. If this is something they're willing to consider, and that would include credit checks, financial stability, and related pre-qual checks.
Okay, great. Let's see. Another one. Can you explain what consequential damages are?
Sure. Okay, so let's take a step back and let's consider 2 types of damages: direct and indirect. And indirect is also known as consequential damages. So when dealing with direct damages, these are paid to an owner to reimburse them for something the contractor was responsible for doing but failed to do, and then that failure resulted in a breach of contract. So an example of that might be the cost to, say, repair defective work. Any additional costs incurred by the owner beyond direct damages resulting from the breach of contract can then be awarded to the owner as consequential or indirect damages. So back to the defective work example I used before, consequential damage of the defective work might be lost revenue that the project owner experiences because of the delay in repairing the defective work. So hopefully that answers that question.
Great, great. I'm looking to see any more in the chat. I don't see any. Okay, I think then, if we don't have any more questions, I think this wraps up this session with you here today. So I'd just like to thank the audience again for spending time with us, and thank you, Mike. Don't forget to join us for our next session, everyone, on Wednesday, May 5th. Those session links can be found on the seminar program page on TSIB's website or in the reminder of event email that you received. Again, thank you everyone for joining, and this session is over.